Hello, everyone, joining our amazing education symposium webinar. My name is Tilmar. I chair the working group education at the Crypto Valley Association, which is, people say, the largest nonprofit association within the crypto and blockchain space. What do we do? The association consists out of several working groups which are working on different topics such as regulation, taxation, startup, security, legislation or regulatory aspects, and of course education, because if you don't know how things know, then you don't know, and people need to teach you. What do we do at the working group education? We have several initiatives in and around education and research. This includes webinars, this includes offline research symposium, and our flagship project, which is our research journal, which got launched in 2022. And how this works is that we annually define a specific topic in the crypto and blockchain industry, mainly to overcome current issues and problems. Then we would invite dedicated authors, or authors in this case can apply to hand in research findings according to that predefined topic. We would then score those papers to reach an academic level that you can recognize those papers in the professional world, combine them or compile them in some sort of research journal, and give it back to the industry. In 2022, we started with opportunities and challenges in the crypto space, relatively broad topic to invite all sorts of authors. It was a success. We continued in 2023 with Don't Trust, Verify, Risk Management in Web3. And the idea initially from this came because of the crash down of several crypto projects in the past years. So there was the appetite and, of course, the understanding of the industry that this new blockchain or crypto fintech industry comes with many risks which we need to overcome. Today, we have the first batch of the best authors who handed in their research papers, and they will today present their research findings. We have backgrounds from technology, people handed in, or authors handed in papers with a legal background, all in and around crypto and risk management. That being said, I want to highlight that also in 2024, we will have a research call for papers with the topic of the future of payment and settlement networks and how stablecoins play a role. But more to this, in a few weeks, we will announce and kick off and start the same process for this year. Now, let's dive into the webinar. We have a range of authors who then now first present their main thesis and then present and talk about the conclusions they have in this specific area, followed by the 1 or 2 minute question and answer round. Now, ladies first, please, Ramona, I would like to invite you first on stage if you want to give a one-liner introduction, who you are, and then I have the slides ready for you to present. If you want me to switch the slide, just say next, and I flick over. So microphone over to you.
Thank you so much, Tilmar. Hello, everyone. I'm a little bit of an odd duck here because I'm based in the Cayman Islands, and yet I'm here in a Crypto Valley Association event. But this is a very, very important topic in terms of risk management. My focus was on DAOs, new areas of research. As a personal background, I am an international lawyer. I come from a traditional background of corporate finance and investment funds. And I went down the rabbit hole of blockchain projects and DAOs. And now I'm looking at how DAOs are really an experiment in the evolution of organizations, so that we can evolve towards more open systems and systems which are across borders. I'm normally based in the Cayman Islands, but I do have a background in European law as well, so I'm not that far. Next slide, please. So the DAOs as experiments have been recognized by several people, including authors. I started the research with really an inventory of what was out there in terms of publications about DAOs, issues regarding DAOs, both in terms of risk management and in terms of governance. And what I found by taking this inventory is that DAOs were both highly experimental. This is very, very early stage. And also the knowledge was very fragmented, very few meta studies, very few really cross-sectional studies or international studies. Most of the papers were looking at DAOs from very specific focus points. So this research was initiated for the Crypto Valley Association journal, but then it was continued. So this is the part to the right. You can see the 4 major conclusions of the continuance of this conversation. We had a workshop in January this year, and then we had a follow-up presentation at Denver. So DAOs are very different animals because the patterns of human aggregation that we're seeing right now are actually very different. And we're just starting to understand the patterns. So this is a very, very important factor because different structures, different animals would behave in very different ways. And they will have very novel risks. So we're talking about emergent risk, we're talking about unknown unknowns. This is a very, very risk-prone area. And then legal wrappers are currently inadequate because there is no real tie between the consensus mechanism and the corporate governance of the traditional legal wrapper. We're starting to see an evolution of this with the Wyoming Dunas, for example, this year, but we're still very early stages. Next slide, please. So how can we apprehend this in practice? And then coming from a traditional risk management background as part of a chartered governance professional, I try to apprehend in terms of where would we be on this, how to apprehend risk in DAOs. So going from a more siloed approach that currently exists, focused on technical risk, more contract risk, and then financial risks, how can we get to a more holistic view, like the enterprise risk management, but decentralized? And what would be the methods that we could use to apprehend risks? So I narrowed it down to 4 types of methods: the SWOT, the scenario planning, Delphi method, and the past analysis. So these are recognized in literature as being some of the best methods to apprehend unknown risks, emergent risks. And you can read more about it in the paper, but really the SWOT can be a very accessible, very participatory, very democratic process and an ongoing iteration. Scenario planning can be used in more specific contexts, long-term planning, exit games, end games, and so forth. Delphi method, I think it would work particularly well in DAOs. Delphi method is an anonymous group of experts. Well, the experts are identified, but they provide their opinions anonymously in several rounds until they reach a sort of something joint. So it's a co-creation. And then the past analysis is really about the environmental, the macro environmental factors that the DAOs needs to consider. So these 4 methods would be particularly relevant for DAOs. Next slide, please. So going through that, and also whatever I could find in the literature about risks in DAOs, and also generally in DAOs, in debates, in like articles on the web, right? I try to create a risk taxonomy that could be a starting point, right? So this is not like this is just a starting point. What I would like to highlight here is that we have the governance risks in the first place. These have been recognized in literature, have been discussed. I mentioned voting apathy. I'm discussing in the paper voting apathy, Sybil attack, centralization or governance imbalance, which is the major area of concern, governance attacks, incentive misalignment, because not everybody's building their tokenomics properly, and then the vote buying. So these have been recognized, and there is literature on this. There are discussions on this. Financial risks and technical risks have been extensively discussed. These are the most frequent ones that we see addressed by DAOs, so they were left out of the research paper. I'm focusing on operational risks, because of the decentralization, DAOs have a management gap and a strategic gap, and the management gap leaves them exposed to more operational risk than traditional organizations would have, right? There are no supporting systems, no good onboarding, no business continuity generally, and like there are a lot of issues there. I separated legal and regulatory risks and AML risks because really there could be different levels, different measures to address these. I'm not going to be overly focused on this. Participant risk, I want to emphasize because it's really a new area that traditional organizations do not have, and therefore we do not have the knowledge on how to properly apprehend and address these risks. And they're very important. DAOs would not be able to attract valuable contributors unless they can actually address these properly. And then more strategic risk and like reputational risk. Reputation could be seen as a variant of strategic, but I separated it because this is still very experimental, early stage, very controversial sometimes. So I thought that it would be best to keep them separate. Next slide, please. So in practice, okay, so this is a bit of a block of text, but in practice, how can we address these in a sort of decentralized context? And some easy ways to do this would be to promote organization-wide learning and discussions about risks, creating some guardian roles, like within the community, people with specialized skills in risk management or specialized training in risk management. We have like certain certifications depending on the size of the DAO, the maturity of the DAO. They will have different needs, but essentially we could build a risk management framework for DAOs, a decentralized ERM, if you will, based on the risk taxonomy, guardian roles, and building a risk dashboard to feed these areas of information so that the community remains aware of what's going on, who is addressing what. And then the guardian roles could be very useful in particular because they could have weighted voting or stopgap measures, which do not centralize, right? They're not pushing towards centralization. They're meant only to protect the DAO, to protect the project. So separating these functions from other administrative function could be very useful to maintain decentralization while addressing these areas. So this is in like very briefly the gist of the research paper, and I would encourage you to go explore in there. It's full of the references that I could find. And then of course, this is just the beginning of the conversation. I see that there are no open questions, but I would like to invite it for a minute.
Thank you, Ramona. To give a brief overview of your fantastic work, you have been submitted to our research journal. So to the audience, please feel free to chat in the chat window. The open question, Ramona, happy to answer if there are any. So whilst we wait for the questions, I also believe there's a lot of work to do when it comes to DAOs, right? In the traditional financial world, people just slowly now to understand BTC, ETH, right? Now we got some ETFs there. So the traditional world is more and more aware of, blockchain. But of course, there are much more applications such as DAOs. So actually, I like the proposition you had of some sort of certification or standardization, right? I believe we're still a little bit, further away from this, but looking into the future, I think it can make sense, to understand this sort of organization better. Then actually, when we look at the next set of speakers, their paper is called Fully On-Chain DAOs on the Internet Computer. And when there are no more questions coming, I would be very interested for Björn and Lara to understand exactly how DAOs would work on the ICP network and maybe overcome those challenges using your specific technology. It looks like
that would be fascinating.
If there are
I would like to invite follow-up questions via messaging or reaching out directly. I understand the timing is a bit short and there is much to digest, so perhaps moving on. But certainly continuing the conversation if people are interested. Like I'm very keen on that.
Absolutely. Please, Lara and Björn, it's your time to shine.
Thank you very much. So I'll do the presentation today on the fully on-chain DAOs on the Internet Computer Protocol, but this is joint work with Björn, who is also in the call. and probably ready to answer your questions in the chat. So indeed, our paper was also about DAOs, but maybe we are more tackling a more technical question, and then we'll see how that also comes into play with risks. So if you can go on the next slide, please. As many of you probably know, the Internet Computer Protocol, or ICP for short, is a blockchain. And as many other blockchains, it consists of many different layers. So on the lowest layer, basically, is the hardware or the computers that are running the protocol. And then on top of that, there's a protocol defining how these nodes can exchange messages and communicate with each other and arrive at a consensus, what is the content of the blockchain. And then if you go on the next slide, on the top layer, there are the smart contracts that can be deployed by some users and used and interact with by other users. So naturally, over the time, we might want to evolve this protocol. For example, we want to achieve that messages can be exchanged quicker, that there is, additional storage for smart contracts, or maybe we just want to fix bugs. So a question arises is, who decides when and how to operate the protocol? And in some other blockchains, how this happens is that every person that owns such a computer on the lowest layer basically has to update the software of this computer. And this hopefully happens roughly at the same time so that the full protocol is upgraded. On the Internet Computer Protocol, there is a little bit a different approach, and all of this is governed by a decentralized autonomous organization, or DAO for short. So if we go on a next slide, we see that this DAO itself also consists of smart contracts that users can interact with, and it really controls the full internet computer. How this works is that anyone can become a participant of this DAO by staking some tokens, and then they can make suggestions how the protocol should be evolved. So such suggestions are called proposals, and then other users who also have staked tokens can participate and collectively make a decision whether a proposal should be adopted or rejected. And one specialty that's not true for all the DAOs, which is the case on the internet computer, is that once proposals are decided, they are executed fully on-chain. So this means that there doesn't need to be a person, for example, looking, oh, what is the decision, and then going somewhere and implementing something. But rather, all of this is already integrated. So once a decision is made, it will be automatically executed by the blockchain itself. And this is now kind of coming back to the risk question, right? Why is this beneficial to have such a DAO fully on chain? So one advantage is that there cannot be forks. So it's always a clear decision when a protocol should be updated and what it should be updated to. And also the fact that there is no human intervention required to basically realize decisions has huge advantages in terms of it prevents human errors, but maybe even more importantly, it takes away the trust, right? The trust effect. We don't have to trust the centralized party or person to actually execute what was decided, because once something is decided, it will happen for sure, basically. So if you go on the next slide, next, I would like, so what we did in the paper basically is reflect a little bit of what are actually the features on the internet computer that facilitate this on-chain DAOs. And in the remaining time, I mean, this is just an overview, but I want to give you a little bit an idea of some of these features that are helpful to achieve this. So the first one is protocol embedded node upgrades. I've mentioned that on some other blockchains, to update the protocol itself, all the people who run a computer basically have to collect or have to individually update the software. On the internet computer, once the DAO makes a decision that the protocol should be evolved, all the node machines on the very low layer automatically implement this update themselves. So they're basically observing the decisions, and then they pull the new software and update themselves. This is also connected to a little bit on what's on the next slide, to the fact that the IC distinguishes between governance participants and node providers. So node providers are basically the owners of these computers that run the software in some data centers, but those are not the people deciding what software is run on the machines. Rather, as we have just mentioned, this decision is made by the governance participants. And this has the advantage that now the decision, what is run, is made by governance participants who have some stake, right, in the system, and therefore have a long-term commitment and hopefully make good long-term decisions for the whole platform. If you can go to the next slide. Another feature that helps with on-chain DAOs is that the smart contracts on the IC are by default mutable. So each smart contract can be upgraded, and this includes the canisters that implement the DAO itself. So let's say, for example, the community would like to change the rules of the governance itself. For example, they say, oh, we need a bit more time making decisions. Proposals should have a longer voting period. This can be done by just proposing that the DAO itself is upgraded. And once again, when the decision is made, this will be done fully automatically. And on the next slide, we also see basically a protocol feature that helps enabling DAOs that are very active because having daily proposals also, of course, requires a lot of computation and storage. And those costs are rather low on the Internet computer compared to other blockchains. The Internet computer has a so-called reverse gas model, where developers basically fuel their smart contracts with so-called gas. And then users can just seamlessly interact with these smart contracts, kind of like they would interact with a normal website. So it's not really a difference to be seen compared to Web2 applications. In addition to that, the main DAO that governs the IC is subsidized by the platform. So this means that the voting itself doesn't actually cost anything. So the voters can participate for free. And finally, on the next slide, another feature that helps with just making a lot of decisions is so-called liquid democracy. So by now, you notice that a lot of the decisions that are made are very technical, right? For example, what software should the blockchain be upgraded to? So naturally, not all the users have time and maybe the knowledge to make all of these decisions. To help with that, the Internet computer has a so-called liquid democracy, which means that every voter can decide whether they want to make a decision themselves or delegate their voting power to another governance participant that they trust. And this now achieves that more people can participate either by actively voting or just by making themselves a choice who they want to trust and delegate their voting power to. And this is also one of the features that just enables the amount of proposals and the very technical decisions to be made. Now, to wrap up on the next slide, I want to give you a sneak peek how this looks in action. So this is the NNS tab where everyone can log into, and this page shows the different DAOs that are in the Internet computer. And the top one is the DAO that actually governs the blockchain that we have seen here. If you click on a proposal, this will be shown on the next slide. You then see what this proposal is about. You see how many votes have already been submitted. This is a proposal that was just submitted, so there are no votes yet. And a voter can then decide to adopt or reject the proposal. So I'm aware that this was just a sneak peek, and if you're more interested in seeing what proposals are out there and how the governance works, you can find this QR code will lead you to the NNS tab, and especially the proposal page. And I'm happy to take questions also if they're later upcoming in the chat. Thank you very much for your attention.
Thank you very much, handing up this fantastic paper. And I think this really describes how the ICP or how this would work on the ICP network. I personally find it very interesting. I will definitely dig into. So thank you for your valuable contribution.
You're welcome. Thanks.
We have a full room also for everyone. Please feel free to ask questions. If there are none coming, we move on to the next presenter. This will be Francesco and Marco with their paper on risk management standards for crypto asset service provider. I'm now looking very much forward about the crypto asset service provider you mentioned in your papers and the three key areas which you define need how to say improvement, meaning clearer classification of taxonomy and tokens, due diligence, and as well the risk assessment. So please, Francesco and Marco, looking forward to hear now more from you.
Thank you, Tilmar. So just briefly introducing Marco and I are the founders of Not Your Money. It's an educational and advisory platform for individuals and professionals seeking to embrace crypto with security and confidence. And this paper, as you say, is centered around the crucial role played by CASPs in and recommendations we propose in ensuring consumer protection and with that upgrading the perception of trust in this industry. So obviously we're here in the crypto valley, we're in the crypto space, we love crypto and its incredible foundations for a prosperous new era of finance. But let's be honest, this space, this industry has had a far from impeccable track record. We've seen all sorts of mishappenings, and often we do look at this industry more like a casino than a safe and secure marketplace. Just again to keep in mind, we're looking at this from an end consumer perspective, seeking to deploy capital and assets in this wide crypto space. And we believe that if this industry is really serious about challenging the status quo, challenging TradFi through cutting-edge technology, trustless, decentralized infrastructure, then we really have to do much better. We really need to earn that trust that brought us here in the first place. Maybe if we can just move to the next slide. So we want to focus on the role played by CAS. So for as much as there are decentralized promises, decentralized finance, DeFi sort of platforms and protocols, really the on-ramp to crypto is through CASPs, right? So where are the assets coming from? Where do users go to access crypto? They go through market participants. We call them CASPs, which effectively are just the gateway between consumer and their assets and projects, the vast world of crypto investments. And that is a very broad, murky universe that is often poorly understood. And as such, we believe that these guardians, these guys are not just market guardians. They're not just, or actually, they're more than market guardians, if you want. They are really there not only to provide access to the projects to users, but also to ensure that their interests are truly adhered to and kept at heart. Maybe with that, Mark, I don't want to know if you want to complement that. Perhaps we can just jump into the recommendations you briefly outlined, and just tackle some of those problem statements and how do we get better at helping users navigate this space.
Thank you very much, Francesco. Sure. So if we can move to the next slide. So here now we want to propose basically a framework, guidelines on how to operate if from the CAS perspective, and you can read the full description of what we propose in our paper. But just from a high level point of view, basically once the CAS, they are this entry point, right, for investors to come into the market and from fiat money to come into the market. Now, after that first step of business decision to a certain extent, we wanted to create an all-encompassing architecture, a framework within products and asset can be issued. So in our description, what we see is that three different vertical axes, if you want. First is the mapping. It's trying to assess where that specific product or asset fit in. So we need to have a clear taxonomy that needs to be transmitted, that needs to be disclosed in a transparent manner towards users. So if I am investing, if I open today any centralized exchange or most of the other crypto providers, what I will see is basically a list of tokens. Now, list of tokens means almost nothing. We need to understand that each token have a different category and classification, and per different classification there are inherent risk and an opportunity there. So it's important to first understand in which bucket every single product or asset falls into. And then moving on, like the two major axes that we identify is what we can offer. We can call it pre-offering and post-offering, right? Following like the mentality of an institutional investors that does pre-trade assessment and post-trade assessment. Here, what we want to see is that first of all, in order to offer something, you need to do your due diligence, and that due diligence, again, these are guidelines, okay? So everyone can effectively implement those guidelines in a different manner, but it's very important that we start to set up some rules in which we have to adhere. And though this process needs to be clearly disclosed and transparent to not only the investors, but also to project that wants to get listed. And then we need to clearly scratch the surface and start to dig into understanding who are the people, the most important and influential people behind that token or product. How does it work exactly? What's the level of risk from the technological point of view, as much as from the financial point of view that this specific product can have? And we should also need to be sure that that process is not always thumbs up. Sometimes it's a rejection out of this process. And that is important because it speaks about the quality and the standards that are provided. But once a project actually managed to get listed, or a product managed to get listed, then it's important to give out a level of quality, how much we trust this as service provider, how much we trust that product. And this one, it doesn't need to necessarily come from everything on an internal side. There are many things, and since we are in a crypto space, everything it's modular and can be connected. There are many projects like Certic, for example, who is a crypto auditor, or DeFi, or any other D.Fi, who actually create crypto indicators to assess the trust and the quality of a project, and that could start to generate a certain level of trust towards our consumers, as well as any other metrics. Again, since we are in a technological environment, that we can extract for a project that has a very important DeFi presence, TVL, amount of transaction per day or yearly. It's important. It's a metric that speaks about the quality and the value, the fair value of a project. And that can only be something that must be done on a 24-hour. It's a continuously monitoring effort, because the guidelines here stands to protect the customer, not to push the business opportunity forward for a service provider. And then at the end of all of this, there is maybe a more horizontal and very important effort that needs to be made, which is one is always alert and always inform the investor about anything that could happen, and about everything that we actually list, everything that we put out. So, for example, a trust score requires an informational tooltip, as well as an educational side where people can understand exactly how that metric, how's that indicator, how's that measure has been created. Otherwise, it's just random numbers that are not understood. And also make people understand that there is a differentiation in between their perception of risk and the reality of the risk. A token that is perceived to be extremely, there are many examples, unfortunately, in the past year. Well, let's just name one. Terra Luna and UST was perceived stablecoin. Well, just because it's classified stablecoin doesn't mean that it's stable. We need to understand what the numbers stands behind stablecoins. What are the metrics that assure me that this is really pegged one-to-one to the asset that needs to be pegged to? So those information needs to be disclosed and needs to be easily available to an investor, and then he will or she make their own choice in what to do, in where to invest. That are, we believe those are the bare minimum and a very high level framework that every CASP should implement in their own, let's say, sauce, in their own way, but at least to prevent more cases as the previous unfortunate one. Thank you very much, and we're welcoming any questions you can have.
Thanks, Marco and Francesco, for this wonderful piece of work when it comes to risk management. And I fully agree, or everybody working in this industry, that it is difficult to navigate in the difficult crossroads within the blockchain industry, right? You need to do your own research, look into the team, which backgrounds they have, right? But this is just, let's say, the social research. Then there's technology or technological research, right? Does the project make sense that specific team sets up? And then we can look at regulatory projects. Just because the exchange is the largest in the world, if it has a weak foundation somewhere in an exotic island, it may be not exactly a project somebody maybe wants to invest in. So anyone who is interested in understanding more about those risk factors when it comes to crypto asset service providers, please take a look at the wonderful paper from those two authors. You can freely download this on cryptovalley.swiss, and there you find the research journal. As Marco said, question answers are open. Please feel free to drop the questions, of course, in relation to the topics into the chat. And I'd like then to move on to our last author duo, which is Henry and Nicholas, with their paper more from a technological point of view, and risk-adjusted returns in automated market maker and the liquidity. Obviously, when you deposit any crypto assets in some sort of liquidity provider or AMM, so to say, such as Uniswap, it comes with certain risks. And Henry will now shed light on what are those risks and how to mitigate those risks. Henry, looking forward to hear more from you.
Lovely. Thank you very much, Tilmar, and thanks for having me on as well. Hi, my name's Henry, co-founder for 512M, the investment advisor for the world of DeFi. We're specializing currently in the world of stablecoin returns. Tilmar, next slide, I guess. Yeah, there we go. So in our paper, we intended to set out and find, given the increasing complexity in the world of decentralized exchanges, moving from constant product to concentrated liquidity, whether we could find any fair methods by which we could see whether returns in the space were justifiable compared to other asset classes, and whether there was any means by which to address the risks in these markets. However, when we went into our basic findings, we found that the logic in this market often follows what I see as my favorite joke in the world of DeFi, is that there's plenty of D and not really much Phi when it comes to DeFi. The financial knowledge that comes around and is applied in this market is usually wielded by people who've gone through Wikipedia rather than had operational financial roles. So the mathematical solutions that people have been proposing so far and historically in the world of decentralized finance, such as those in concentrated product automated market makers, have been purely theoretical in design and difficult to execute in reality. So our basic findings when we went through and were looking for situations and solutions for risk in the world of DeFi, we really didn't find a huge amount. And of course, when studying concentrated liquidity, while we see it as a massively beneficial change in terms of liquidity and the efficiency of these systems when it comes to capital efficiency and execution, whether that be slippage or required assets under management to maintain effective exchanges, there are beneficial parts to the increased fees, as an example. You generate increased fees from the world of concentrated liquidity automated market makers, based on a study from Fridge back in 2021. However, when we're looking at concentrated liquidity automated market makers, a phrase I will continuously repeat over and over again, and is a terrible tongue twister, they have a severe drawdown in terms of the impermanent loss that you take by creating virtual reserves based on far lower allocated capital as LPs. The losses and the position ranges can lead to massive impermanent loss for allocators as LPs. Now, when we are looking into solutions to cover the risk in these models, we found a few proposed systems that work for constant product automated market makers, such as theoretically proposed weighted variance swaps, which were very interesting to look at, but you need a maths degree to break them down, and their operations in reality are difficult to execute. Or long option straddles, which are possible, but the technical complexity or the knowledge required to execute these effectively rendered this part of DeFi out of the hands of anyone in the world of retail. Now, outside of that, these theoretical solutions we found, purely based in very complex and quite ugly mathematics, which we will show you later on, are often in real practice entirely mute when you try to apply them to actual market strategies. Often those solutions in a fair market pricing would eclipse any fees that you generate, making them unprofitable to even implement. Next slide. So the idea that we took instead when we found that, and we were looking into the market and couldn't find real applications where risk could be mitigated, specifically financial risk rather than smart contract risk or other associated risks to counterparties, would simply be to identify a fair comparison for the pools themselves. Because as many of you see in the world of DeFi, if you go on any platform or protocol whatsoever that can offer you the yields in concentrated liquidity systems, they simply state quite frequently purely just the TVL, the average trading volumes in the last 24 hours, and the APY that are generated from the pool themselves in terms of fees. Now, these figures are often highly misleading to those in the world of retail who might not be armed with either institutional grade analytics behind or a degree in quantitative mathematics to work out what their potential risk is in this market. And so our idea instead was to come at this from the angle of finance rather than decentralized finance, which is in a market where there is risk, which is difficult to escape and outside of theoretical applications cannot be avoided. Is there a fair way in which you could make better decisions in a risk-adjusted basis and compare pools and allocations in concentrated liquidity to get an assessment as to whether it's worth it to be an LP? So for this, we took the approach of Sharp as an example. 1996, Sharp comes out, wonderful paper, which is used, and most people who have experience in the world of traditional finance will know, is the most common reporting figure for the risk-adjusted returns of portfolios and often used in the world of fund management. Now, for an equivalence for that to be built in the world of DeFi, which would allow consumers to be able to compare pools for their risk-adjusted returns, we had to figure it out for ourselves with the disgustingly ugly maths of concentrated liquidity market makers. Now, for that, we had to look into not only the estimated fees from pools and how the price ranges affect those estimated fees that could be generated, but also then the expected performance of the underlying assets and fair quotes for the volatility of these assets, including the rebalancing effects of the assets in a concentrated liquidity automated market maker. Now, for our estimate of fees, we based our work there on a few papers that have come out of the world of the ETH and the University of Zurich Blockchain Center for the fair estimation of fees, where as you tighten your price ranges, you would accrue a larger portion of the effective fees that have to be distributed amongst all providers of liquidity. As of course, by fair estimate, your liquidity will be utilized more often to execute those trades, and you would be the recipient of those fees. So our fee estimator, we constructed a fair fee estimator based on other research work. And then, of course, to look into the value of these portfolios, we looked at a portfolio position of Ethereum versus US dollar, USDC, based on Uniswap. And from there, we generated our own forecasting system. So as you can tell, this is a rather ugly piece of mathematics. And for calculating Sharp in this way, there's no pure calculation of volatility for allocations in V3 Uniswap math. Because of course it also has an element of game theory within that, which is for the rebalancing effect of arbitrageurs and also external price oracles that affect it. So instead, we simply used the implied volatility that comes out of options markets. Since from the previous slide, you can see that the payout structures to allocations as a liquidity provider and concentrated liquidity often are very similar in their payout structure to short put positions on the relative instrument. So for us instead here, after some very ugly mathematics and a lot of time on a whiteboard, we came back into generating the Fudge-Alioth ratio, which is from myself and my co-founder, Nick. And actually, Tilmar, do you mind skipping back to the last one quickly? So for this one, it was just to give a very simple overview for participants in the world of DeFi to compare pools dependent on the assets underlying, to give a simple figure which can show them whether it is a better pool or not, which we think is massively lacking in the world of DeFi. That, of course, as the previous presenters covered quite well, often there is a lack of information and understanding, which is a huge gap for these participants. And of course, for fair comparables, we often lack those. So for this as well, it also gives you a benefit if you have a targeted ratio that you were looking for, or a relative taste or risk tolerance in terms of risk-adjusted returns. You can also back calculate from this the size of the position range that you'd like to target also. Now, of course, this does come with some drawbacks. Of course, working over a very short period in our study that we found. Of course, more details can be found in the paper. And of course, the difficulty of the high kurtosis of returns in the crypto asset market. And then, of course, the issue of the game theory here, which would be that in a market of N participants where I can generate optimal returns with a certain price barrier, why would someone with the same price, with the same risk tolerance, not come in and set a price tolerance which is one tick shorter than mine to generate higher fees than me and crowd out my trade, which is a difficult one to cover mathematically. Next slide. Back one. There we are. So during the forecasting period, so we did this on October 17th, when we were running through this simple estimator for an equivalent Sharpe ratio for the allocations in concentrated liquidity. When we were using an estimator for implied volatility taken from Deribit option quotes, short put for ETH instruments over the forecasting period with a similar duration, we ended up generating figures which were pretty poor, in line with a lot of other empirical research, particularly from Heimbach, who has some incredible research papers in the world of DeFi, for a relative risk-adjusted return, 0.2376. For those who are vested in the world of traditional finance, if your fund manager has a Sharpe ratio of 0.2376, they won't be keeping their job for too long. That obviously would not be a perfect score. Of course, usually the best rule of thumb is above 1 is good, below 1 is okay, below 0.5 is certainly not great. Now, when we optimize that for a certain set barrier price, as we see with the first graph, for a high price of 3,000, assuming a symmetrical allocation of liquidity, we had maximum figures that were in terms of duration by days at approximately 155 days, accounting for the chunks that occurred there in the graph based on the non-continuous distribution of options expiry dates. So when we opt for a perpetual options market and go for a continuous volatility surface, we're looking at 150 days was approximately where we were finding an optimal timing for the position sizing that we had to maximize the ratio. When we then set with that constraint and re-optimize then for the price high limit, which would then, by our symmetrical assumptions, set our low prices, we found that tighter price ranges around the spot price. Again, for price relative at this time, we're talking about $1,602 Ethereum. And we found a price range of $230 plus and a small bit below as well there, found it to be the highest. But again, even with complete optimization on both time and on the price ranges in play, we found that at the best case scenario, we were getting risk-adjusted return figures as stated by Sharp at 0.328. Again, not incredible. And of course, then since that date, for the position underlying, it would be entirely out of position and you would have experienced rather severe and permanent loss, with your position being entirely denominated at that point in USDC and being able to participate very little in the recent upside in Ethereum prices. Obviously not today, if anyone's been watching the charts. Now, when we're looking here, we just find that even in an optimized scenario, even with perfect information, currently the returns adjusted for risk in concentrated liquidity are simply relatively poor, even with optimized strategies. We found this to be a relatively useful estimator that continues to need some further improvement. And of course, we're testing this in certain pools as well to adjust for the fees, including across concentrated liquidity automated market makers on layer 2s and Solana as well, to reduce the noise effects of the performance of the allocations by fees also. Last one. And of course then, while concentrated liquidity is a great development for the world of DeFi in terms of the efficiency of exchanges, the slippage that persons can take while they're executing trades in the world of DeFi, we find that both in a conceptual style and in a investment style, they have something severely lacking. Conceptually, the world of DeFi, to democratize finance and allow access to the tools of finance to everyone at the point of use, we feel that this move towards concentrated liquidity is a massive added complexity, which currently retail has no ability to effectively price in terms of risk. And conceptually, it's becoming massively more complex for them to be able to participate. We find this is becoming just purely another place for institutions to play, especially when you see that strategies are far more performant when people are changing intra-week and intraday at most larger decentralized market makers who are playing as LPs in this space. Outside of that, we're looking to continuously improve this metric and hope that DeFi in general will embrace more standards that allow for fair comparisons of risk and reward, just in terms of investor disclosures. Because of course, due to the nature of our industry, we're dealing heavily with the world of retail. And we think right now it's being underserved by these providers that are simply providing a complete lack of information on the risk of these positions, while highlighting very, very strongly the APYs in large numbers that people can gain. There's no DeFi protocols that are showing people where is the optimal place given a certain risk tolerance. And there's very few that are accurately or transparently discussing the risks that can be involved here. But of course, for further details and some look at some disgusting mathematics, it's really pretty ugly stuff. You can check the paper as well, but for us, we'll be continuing to test this metric as a forecasting metric and releasing some further data as well in the next coming months about its accuracy as a forecasting metric. Anyway, thank you guys for having me. And of course, if there's any questions here in the chat, please happy to answer.
Thank you, Henry. And of course, also big thanks to your partner, Nicolas, in writing and handing in this paper. I think that today we saw the different risk factors when it comes to DAOs, how it comes to crypto as a service providers, and obviously, last but not least, by liquidity or concentrated liquidity, automated market makers. I agree, as a tongue twister, but a term we should all remember working in this industry. I want to encourage everyone from the audience, the knowledge-hungry people, please go to the cryptovalley.swiss website, download the research journal. It is for free, and then you can read all the different papers of the authors. Also, stay tuned for the call for papers 2024. The shout out will soon be made online. And last but not least, thank you to the authors for participating, handing in, bearing in with me until we organized today research finding. I think it's valuable work we contribute and will impact on the industry. That being said, get your ticket for the Crypto Valley Association conference in 6-7 June this year, just about a month. And I hope to see everybody soon again. Thanks, and speak to you soon.